Welcome back to How I Franchise This. And today we have a little bit of a different episode for you. We are pulling a few key highlights of some of our most insightful conversations around franchise financing. Financing is one of the biggest parts of buying a franchise, and it can be really complicated really fast. We've been lucky to talk to some amazing guests who have grown from a single unit all the way to dozens and even hundreds of locations. And they had some really great insights in how they scaled their businesses and the financing behind their growth. First, how Taylor Byington and Shideleler Bennett raised money to launch their Crumbl empire, and how they made every mistake in the book while financing their first deals, which led them to be in a really cash-strapped position. Through a lot of hard work, they found their way through that and now have several locations open, and they share with us their preferred financing structure and what they would do differently if they could go back to day one. So one other question on the financing. You guys don't have to, obviously, with respect, you guys don't want to share details, but for anyone out here like listening about, okay, I'm gonna go raise money from friends and family and do this like private round or private lending, like how would you recommend structuring something like that? Was it like, hey, we'll pay dividends up to a certain point, we'll give you equity up to a certain point? Like, what is your advice on how to structure a deal like that for someone doing it for the first time and not really knowing where to start?
I mean, I'll be as open as I don't know, Shad, if there's anything you don't want to say, but
Oh, go for it.
we made every mistake under the sun. We were way too generous on that end. We gave a blend of it was equity and debt, and
Okay.
way too much equity. So really, where we handcuffed ourselves early, and this is the part of the story that people don't get. I don't know if I've never told anybody this side, is we ended up getting cash strapped because we were giving it back so much in the form of debt that then it was like it would be this like weird conversation around, okay, here's the debt payments, but then equity would be, there'd be some allotment for distributions on top of that, and so they'd be like, well, this distribution is not quite as high, and it's because we were accelerating a debt payment. And so I would say the lesson that we learned there is, number one, I think we're both kind of in the same. We run by the same code on this. Super fun to be generous, and I don't regret. We wouldn't have gotten to have the opportunity if we weren't generous. So
Yeah.
that's the one variable. Is I'm still happy with what we did. It was a wake up call when we realized, right? Oh, the rest of the world doesn't structure, equity and debt to be almost like one and one. And so it's kind of picking. If you're going to if you're going to raise debt, you really need to have the confidence that you can manage the debt, because they're going to treat you like a bank, or you should treat it like a bank.
Yeah.
And if it's equity, I think that what we could have done a better job on the front end is just establishing, real expectations. We kind of set the bar so high that we established it for all equity partners at the top tier of that benchmark, right? And so anything below it was not like anybody's acted like they were unsatisfied, but we oversold what the opportunity could be. I don't know if you have anything to add to that.
Well, I think the other part is going back to the timing of it. When we were getting this money, a lot of the notes that we signed with these investors were at 6%.
Mm.
So now that's just as cheap of money as you're never going to get commercial money right now with that. So it was good. There were expectations that because we're taking their money, we would try to get it back quicker than the term we established. But at the same time, that meant if things were lean, we wouldn't make payments, right? So different than a bank where we did have flexibility that way. And that actually saved us in a lot of ways. If we would have had all bank debt, it would have gotten really scary. And, now we know there's a lot more that you can, work through with a bank. But we did. I mean, we utilized SBA loans and had the investors put up the down payments. We have most all of our debt in conventional long-term, very prudent vehicles. And we're also still paying down debt as aggressively as we can, more or less, because we went through a time where we were worried about the outcome, and it would now hurt a lot more to lose where we're at than to, stretch ourselves and grow too fast. So it's just like we've got 3 kids each. We're trying to keep them in the home and not lose it at this point. So yeah, I guess that's my thoughts.
If you guys knowing what you know now, still went back into this like cash strapped early days position, but you now know like you've had these learnings under your belt. Like what is the ideal structure? Like how would you structure it now if you had to start over again and maybe didn't have access to SBA loans, or other, options?
Interesting.
I mean, I can speak to this. Taylor and I have talked through these things over and over again. I don't think there's one perfect thing, and you've got to really spend the time to find what investors want. Is it cash flow that they care about? Are they okay being equity and having to pay out longer term? But the more you can avoid, like Taylor said, doing both, in our experience, is better. So even if it was something like you're going to give them a stepped up equity stake to get it open and to fund it. So even if it's 70-30, to use actual percentages, once their principal is returned, flip that to be a 70-30, and then almost always try to have something in that agreement where at a certain time and for a set multiple, you would be able to buy them out. To me, especially on your first franchise, I would suggest that structure to anyone, because one franchise is not going to make you rich, but it could break you. And if you did someone that has risk and equity, man, it just can make your life so much easier. And then if it is successful, great. You'll be glad to buy them out and grow yourself or continue to grow. But now you still have the lion's share of the opportunity, which makes it worth it for you. So I guess that would be my recommendation.
I like that.
I mean, that's the structure that we, on our most recent deal, that more or less is the structure on the purchase. And the spin that you asked for, just framing it back, I 100% agree with what Shide said. I think that structure also incentivizes you to be an operator, right? Like, you have to be in the driver's seat long enough to see, like, can I scale this? And I would say that's a step that we skipped that actually became a crutch for us, because we had never actually experienced being the store manager, right? Because it was all remote. And so there would always be these hiccups where, we weren't really able to speak at depth with the manager or turn it around to the investors to give actionable insights. Whereas if you have that muscle as you going from 1 to 5, you can't get talked over. You know exactly what the variables are that are either constraining you or the levers you should be pulling on to go maximize the return.
That's a really good point. Something like, Dan and I did with the laundromats that we did almost unintentionally is we worked every position we ever hired for the first like few years, because we felt, one, because we couldn't afford to to do anything else a different way. But then in hindsight, it was like, oh yeah, let's tell everyone that was by design so that we could, yeah. Yeah. But it's true, like it paid so many dividends in the long run because we could talk to every position. It's like at some point, Dan and Alex did all those things that everyone else is doing now, whether it was like doing the delivery routes or washing the clothes at 3 in the morning, the laundromat, like trying to find a better way to do it. And I think that's really good advice, is to like try to find a way to replicate that, or get in the operator seat so that you can build that muscle and be that resource for the team. That's good advice. Such a great and open conversation with Shideleler and Taylor there. Now let's zoom out. Kal Gullapalli has scaled to more than 100 units across multiple brands, and in this clip, Kal and I break down a hypothetical deal and how you'd structure financing for a 20-unit acquisition. Kal is a legend in this topic and has done this many times over. That's kind of, it leads up to my next question is, at this scale, how do you finance this? And it sounds like, for the European wax deal, it was private equity, but I imagine each deal is a little bit different, right? Sometimes it's debt, sometimes it's equity. Have you ever used SBA loans? I mean, walk us through how you think about financing a deal, especially at this scale.
Yeah, so usually, like if it's a smaller brand with not that much recognition yet, like if they're growing, they're mightily growing and doing a really good job, SBA is really the only route if you're not 100% cash. So some of the smaller brands that my family owns, we're the only investor, where we only have 1 or 2 or 3 locations. We're the only ones, and we do still use SBA. While the SBA is highly, there's a lot of administrative work to get a deal across the line, it's a phenomenal program to get, a deal done. And so even kind of at our size, 80 units or at 1.130, the SBA still is very relevant. Now, when you get to, what we were talking about before, where, you want to get to 50 locations in a brand, there are middle market lenders that we've had great relationships with, that we've used to help, create these term loans. And on top of that, delayed draw credit facility so that we can expand, whether it be through acquisition or de novo. And there's many banks that are looking for, great operators to deploy this type of capital in.
And so when you're in, some of the concepts that you're in that are, say, sub 5 units, that's when you'll say, hey, let's use the SBA lever. And remind me, can you use up to, is it 5 million per concept, or is it per individual that the SBA starts to cap you out on?
Yes, I believe, and you should double check this with ChatGPT,
Yeah.
but I think it's 5 or 5.5 million per person. So, you can't have more exposure, and if that 5.5 million carries across brands, so you can't do 5.5 in this brand A and then another 5.5 in brand B.
And this is another thing, don't hold me to this, folks that are listening, is I think there's even an exemption too if you have a net worth below 100 million or something. There's a way to get up to, I think, 12 to 15 million of SBA if some of your businesses are providing, I want to say it's like either green initiatives or some sort of community efforts. Like for our laundromats, for example, our washers and dryers were energy efficient, so our franchisees were able to borrow more than the initial 5 million. So check that out too if you're listening. If certain concepts or businesses you're looking at, they might qualify for some of those exemptions, and you could borrow more than the 5 million cap from the SBA. But again, don't hold me exactly to that, but check it out. Okay, so you'll use the SBA for smaller deals. You'll start to use private capital and other, or as well as other banking options for some of the larger deals. Could you give us like a use case of one of the larger deals of like, hey, I try to structure it this way. It's 10% cash down on my end, then I'm borrowing 40%, and then it's private equity or private capital in for the other 50, and here's how I structure it. It's over 3 years. And we don't have to get into exact details, but just a hypothetical scenario for someone listening to, I think, better understand how you would think about putting a deal of that size and that complexity together.
Yeah, so hypothetically, let's just say that I'm buying 20 locations. EBITDA is like $3 million. Okay, let's just say it's trading at the transaction. Let's just make it easy. The transaction is $20 million, right?
Yep.
And let's just say that the cash flow again is 3 million. And let's just say EBITDA equals cash flow. Okay.
Yep.
So in that case, I need to find $20 million, probably like 22, so that we have working capital on balance sheet. So out of the 22 million, I'm looking to generally put in 20% of the equity, right? So
Yep.
close to $7 million, right? Maybe 6.5, $7 million. So out of that, I'm either writing that check myself or I'm syndicating out some of that equity so I can raise it. But in the meantime, as I'm going through that capital raising, I need to find the additional $16 million, right? So once I go to, I have a debt lender broker that whenever I need to get a deal done, he gets it done for me. But he's syndicating out to all these banks that have interest in this particular brand or this particular sector. And he or the direct relationships I have with certain banks, I'll go to and say, hey, do you have any interest? And for example, like there are banks out there, like for Dave's Hot Chicken, for example. I mean, there are 5 to 7 banks that are aggressively looking to get more exposure into Dave's Hot Chicken, right? And I could say the same thing about European Wax Center or Orange Theory, that there were multiple banks that wanted exposure. And so the underwriting process, if you go to one of those banks, is much easier than say you go to your local community bank that doesn't know anything about the brand, right?
Yep.
So to get that extra slug, I mean, you'd go to the preferred lenders first, and then number 2, you'd go to other middle market lenders who, may take a little bit longer on the underwriting process.
And so you'll finance 20% equity, whether it's syndicated, your own check, it's at partners, et cetera. The other 80%, debt financing from one of the banks. What do the terms typically look like on, non-SBA bank loan like that? Is it, the current market interest rate over a 10-year period? Is it 5 years? What are the, I guess, like in hypothetical scenarios you typically see?
Yeah, it varies all across. I mean, you have debt that's interest only for 5 years. You have debt that's and the interest can be like SOFR plus 4 or 5%. And so generally the effective rate of loans right now in July of 2025 is somewhere around 8 to 10.5%. And then you know, you're playing around with amortization. Sometimes the debt will expire and you have to refinance in 5 years, but the amortization will be 10. So there's a lot of different, and some, middle market lenders, not the small ones, but the middle market folks will allow you to pick the interest, right? So you can pay in kind, so the debt increases over time. And you're basically paying interest with more principal. You're increasing the principal. So there's so many different types of options that you can kind of pull, but usually the more sophisticated options, like when I'm saying with like pick interest, that happens with the middle market lenders. That's not happening in the SBA. The SBA is going to be very, very rigid on how they kind of view it. But the SBA will give you some time for construction periods or an interest only period, even on acquisitions. They have a few levers, but the more levers come when you have like bigger loan amounts.
Yep. And so it really is like you're using all these different tools in your tool belt. It depends on the deal, the brand, the market, a lot of different factors before you decide one path or the other. Have you ever leveraged like private debt to finance any of these deals instead of it being equity? You'd go to groups of family offices or other groups and say, "Hey, I need to borrow 10 million and I'll give you, or a couple million and I'll give you just a set interest rate that could move faster than a bank, maybe."
I have not. I've used family offices more on the equity side. Or yeah, and but I've not used a debt vehicle on the private side yet. But I mean, I know a lot of folks that do that, um, and it could be very attractive because their speed to market is fast, and they can underwrite the deals much quicker because they don't have huge committees.
Yep. And sorry, one more question, because I think people will be curious about this, especially those going from, a few single units to starting to go bigger and, raising larger capital like this. What's your target, like, ownership percentage? Let's say you're about to buy 10 units of something and you wanted to use the, hypothetical we just walked through of 20% equity, the rest financed via a term loan. What kind of equity ownership target would you have for yourself for structuring this deal, ultimately operating the business, going out and raising the capital, running it, et cetera? What is market, or what do you think is fair or a good deal for, the operator or the owner in that example?
Yeah, I don't know that I'm market, but I for me to be excited about something, I need to have at least 30%. That's the bare minimum for me to own, and I go upwards. In a syndicated deal, I go upwards of 55.
Okay.
But it's also very important that whoever's invested in me gets a solid return. So I want to make sure that the model, even in the mid case, provides a great double at a minimum double-digit returns. So that I'm cognizant of both, but I have to make sure that I'm excited about it every day.
Yep.
Otherwise, I don't. It's not worth my time.
And you were saying you might not be market. Are you on the higher end or the lower end, or what do you think market would look like
I,
on
I think
average?
I believe I'm on the higher end. I've seen people get better deals than mine, but I also have seen folks kind of running the 2 and 20 model, the traditional private equity model. And I don't see how that works, especially when you're not at scale. Like if like, let's just say you're buying 10 Crumbl, or let's just say 5 Crumbles and you're doing 2 and 20 model. I don't see how the economics work that well, unless you have a great path for acquisitions or new de novos and you can get to 50 to 100, because the 2 and 20 model works really well when you can deploy large amounts of capital.
Mm-hmm. Interesting. And then I was going to ask, so when it is a situation where you own less than 50% of the business, is there ever any concern about control, or, could this person eventually say, "Hey, we're going to put a different operator in"? And is that a worry that you would have, or any advice on that topic?
Not yet. I mean, could it happen? Yeah, certainly. But knock on wood, it hasn't happened. But we've also been performing, so that usually happens when performance has kind of gone sour.
But that is a risk, right? I think for people that are, maybe again thinking about doing this for the first time, this is a way to go big and to get dozens and dozens of units open, but some of the risk is that you are working with other people and you might be giving up some of that control in exchange for speed and scale. Is that a fair thing for people to have to consider and think about?
Yeah, it's certainly fair, especially if you're, going with a like one family office and one private equity firm who owns the majority. That's a very real possibility, right? But if you have a syndicated group, a diversified group, that's a little bit harder to, have like a material event to kick the CEO out. Now, I think that all, operators should be very self-aware and saying, hey, if they're not the right person for the role, they should step down. But
Raise their hand. Yep.
yeah, yeah. So you owe that to your shareholders. That's your fiduciary duty.
Yep, completely agree. I mean, that's why I think especially, and this is different, it's for venture capital and tech startups, but this idea of governance sometimes being a bad thing. It's like, I don't know. I think sure, sometimes you could be too early in the company's life cycle where it's like, you just need to go fast and you don't want to be bogged down by some of the more kind of bureaucratic processes and conversations. But governance, historically, if you look at all the data, has drastically improved performance and the success of a business for the exact reason you just said is everyone has to have this fiduciary responsibility for the business, for the owners, for the investors. And if you're not the right operator at whatever stage in the business's life cycle, that's okay. It's part of the business evolving and growing, and either you grow with it or you have to level up the team and keep the thing going because you still have a vested interest in it. So two very different perspectives, one from raising friends and family money on the first deal, and one from structuring institutional level financing for dozens of units. Both drive home the same point: getting the financing right can make or break your franchise journey. At Franzy, we help you navigate that process from finding the right franchise fit to understanding how to structure your financials to making sure you have the right partners in place to grow and at the right time. If you're exploring franchise ownership, check us out at franzy.com.